Welcome back. John Van Limbeek joining us from Abbott Wealth Management. Usually this is on Wednesdays, but of course with no show on Wednesday, we thought we'd have you guys on earlier in the week. So thanks for being here.
You're welcome. Thank you.
Yeah, we're talking a little bit about this year's dividend increases for some Canadian corporations.
Yeah, I always like coming and talking about that. It seems to be my focus, I guess.
Yeah.
And now we basically got 11 months of year-to-date numbers, right? It's a short term when you look at it that way, but nonetheless, it still matters in regards to the bigger picture.
Okay.
So even though the general market is in Canada is negative on the year and maybe close to negative 10%, most of the Canadian companies have raised their dividend somewhere between, let's say, maybe 5 to 12%. Some of them more. CN Rail is up 25%.
Wow.
And that's just not a one-year number. It's usually happened in the last 2 or 3 years with them. And so you do have to look over the longer term, but the fundamentals of the businesses in Canada are strong.
Yes.
Or have been strong. Again, these are all rear-looking numbers, but nonetheless, they've been strong for the year, even though the market shows weakness. So, CN Rail up 25%. That was raised earlier this year, January, February, March. Stock price is down about 5% on the year as of today, give or take a little bit, right? So you're seeing that disconnect between what the true business is doing and what people in the stock auction are bidding on the price or saying the price the business is worth.
What would you say to somebody who says, oh, I don't need to diversify, I'm just going to do all CN Rail all the time, look at how well they did?
Yeah,
the laughter says it all.
That's a tough one, right? I mean,
but some people really operate that way.
If you could, history, absolutely. Absolutely, but history is, more so in the banks. The bank's been around for, over a century. And if you just took that thought and said, yes, that would have been probably one of the better decisions anyone could have done anywhere.
But nobody has that crystal ball.
Exactly. So now we're, like you said, yes, the numbers look good for this year, and they are good. But what does the future look like of that business, right? Now you can get into CN Rail and CP. They are good businesses. They're not worth an infinite amount of price to pay for them, but they're still a good business to have. So, but you still have to diversify because, again, Canada's feeling a little bit more than the world. If you're heavy in energy, and some of the energy companies are doing well from a dividend point of view, but for share price point of view, man, they're down 20, 30, 40%, some of them still, even 50% from last June. And that's a big number. So like you said, it's a big number to feel, and we're feeling it as a country, right? So you do have to have diversification around sectors, around geography, inside Canada, outside of Canada, and stuff like that.
Some great companies that are doing well, amongst them WestJet, 16.7%.
Yeah, there's another interesting one there.
Yeah.
It's not the typical one you think about all the time when you think about big dividend-paying companies, so it is a smaller company. But again, its share price is up 17%, or sorry, its dividend is up 17% this year. And share price, is down a little bit, right? Again, it's not, and this is where you got to take a little bit longer term view. I mean, we have to look at the numbers now, but we also have to put it into context about what's going on, right? Load factor is still doing well for them. That's how many seats how many people or bodies they put in the seats. So it works, or there's a little more positive going on than just taking a snapshot saying, okay, what is that share price today? But if you held it for the last year, you're feeling it a little bit.
Sure.
A lot of portfolios are.
Okay. What about Fortis? 10.3%.
Fortis for so for a gas company, there's not the going against the trend, but again, a very healthy dividend increase. Not unusual for the gas companies to do that. But again, you think of the energy companies really feeling it. The pipelines, not so much. Gas companies, a little bit more. But again, if you can get past the here and now of saying, oh, that's a bad decision because I own it and it's down maybe 10%. CN Rail, it's up 25% on dividends, down 5% on share price. If you can get past the short-term number and just and dig a little bit deeper, or have your advisor talk to you about those, understand that helps you with the long-term emotional connect with the businesses.
Absolutely. Information is power.
Yeah.
We have a question of the week. Maybe we should get to that. We have about a minute left. What is the source of the dividends paid out by corporations, and why is that important?
The source should be after-tax profit. basically. After everything is paid, all the expenses are paid, some money is left to reinvest in the business, to grow the business. And if there's money left over that way, that amount is the ideal source. But believe it or not, even in this day, there's fancy accounting that goes on. Not all with all companies, but it does happen. And you can get, you cannot be, or you can receive dividends that are not necessarily after-tax profits. They could be, maybe they've sold something and given, you know, so you got to be cautious about this saying, okay, it pays a dividend, that's a good company. Okay, maybe, but there's other things to it, and you have to look at that source of where it's coming from. If it's making enough to pay that, then you're okay.
How do you know if it's making enough to pay it, or if they're selling stuff off?
I mean, information's all there. It's just now it takes time to dig into, and this is the hard thing. Is it's very easy to log into your account and says, you know what, it's down, but it's very hard to look at it, the why it's down. Is it a bad business, or is it just what's going on in the world?
That's what you guys are for.
It is, exactly. And, you know,
Right?
and that's why it's so hard sometimes, because the here and now looks wrong sometimes, but especially this year. But really, there's a lot of good happening behind and underneath.
Awesome. John Van Limbeek, it's great to have you here today. Thank you very much for coming by and talking to us a little bit about dividends versus stock prices. It's great to have you.
Thank you.
Yeah. Information on the screen, abbottwealth.com, 372-3736. We are back with Kyle Taylor from Sun Peaks after a quick break. Stay with us.